So in today's video, I'm going to be walking you through the 3 strategies that you can use to get your first, your second, your third real estate property to get that snowball rolling. So you end up with a profitable portfolio down the road that you can use to do whatever you want with, whether it's, just live off the proceeds, give it off to your kids down the road, use it for charitable purposes, whatever that is. So without further ado, let's get into the actual strategies that you can use to get your first, second, or third real estate property. The very first one, and this is a great one to get started. So if you're brand new, you're purchasing your first real estate property, this is going to get the snowball rolling for you pretty quick. Okay. So it's called the BRRRR method. So basically what this means, the BRRRR method, the acronym stands for buy, renovate, rent, and repeat. So let me walk you through exactly how this works. So you're going to buy a property. Okay. And let me just give you an example from when I was doing single family home investing. So this was a duplex, right? So you're going to buy the property for whatever money it is. And now you're going to renovate the property. So in my case, we actually converted it into a basement, converted it into a duplex. So we had a basement unit and an upstairs. So you're going to renovate it. Then once the renovations are done, you're going to rent the property out. So you're going to add tenants. So in my case, we had an upstairs tenant and a basement tenant in this case. Now they're going to start paying you monthly rent. Now, the reason this is important is the bank, especially with a residential property like this, they're going to look at how much rent is being generated. And that's going to help, especially with residential real estate, it's going to help you qualify for more money. So you've got this property, you bought it at X amount, you've renovated it, so you've increased the value of the property by improving it, and now you're putting tenants in. So what this allows you to do, you're able to go back to the bank right now and say, hey, Mr. and Mrs. Banker, I bought this property at X. I've now done a whole bunch of renovations to it, so I've increased the value of the asset. I now have tenants in here paying me money every single month. Now I'm looking to put more debt on the property. The second strategy that you can use, and honestly, like this is where if you look at anybody who's accumulated a vast amount of wealth in real estate, this is what they're doing. And this is the long-term hold. Why is this strategy the best for accumulating massive amounts of wealth? Well, the reason is because the money stays in the real estate market. Because real estate looks like this, right? It goes up, it goes down, it goes up, it goes down, it goes up, it goes down. And you always have these peaks, right? And then each time you have a drop, right? So this is the market cycles. The market peaks out, we drop down, and then the market's going to surpass the previous peak. Over time, real estate will go up. And that's why a good rule of thumb is property values double every 10 years. So you look, and sometimes it's 7 years, sometimes it's 12 years. But generally speaking, if you want a rule of thumb, it's every 10 years, property prices double. Why? Because we keep going through this cycle over and over and over again. So what happens is, if we're trying to have quick wins in the real estate market and time the market, which is impossible because you never know when the peak or the trough was the bottom of the market until after it's happened. It's all retrospective. But in real estate, the secret is the longer you have your money in the market and you're not taking it out, the more you take advantage of the upwards momentum of the real estate market over time. Now, here's the secret to this. Let's say you acquire a piece of real estate. Let's say it's a $1 million piece of real estate. And again, we'll keep it simple. So we'll use a 50-50 for debt on there. So we've got $500K you've put in terms of debt, and then we've got $500K in terms of equity, 50-50 split. The beautiful thing about real estate and using debt as leverage is that $500,000 of debt, that stays consistent. So this is going to be your mortgage. And let's say we're holding this for the next 20 years. that 500K is not going to change. And actually, in fact, like you're going to be paying it down if you're not, if you're paying principal and interest. So that debt stays steady, right? Over 20 years. Now, what do we know about inflation? Well, governments like printing money. And that means we live in an inflationary society, which means over time, the value of the dollar is eroded. So what does that do with our debt? $500,000 today is worth $500,000 of debt. But over the next 20 years, that 500K, that's going to get eroded. The value of that money, that debt we have, is going to erode. Now, over time, we know the value of real estate goes up because of inflation and then improvements we make, intensification, depending on the types of strategies we're using. So the value of the asset is going up over time. The value of the debt, the impact that it has, is actually going to go down over time. It stays more consistent, right? So we're actually owning an appreciating asset. Now, what does this mean? Well, we know the rule of thumb is that property values double every 10 years. So let's say over 20 years, it's going to double once. So that 1 million is going to turn into 2, and that 2 is going to turn into 4. So in 20 years' time, using this rule of thumb, we have an asset worth 4 million, and we still have 500K of debt, providing we don't even pay and we're not paying it off. When we started here, we had debt. We had 500K. We had equity of 500K. And the asset, the value was 1 million. 20 years later, because we double and then it's going to double again, we're going to have a value of 4 million bucks. Now the debt on the property is still going to be 500K. So what does that mean? Well, now the equity that we have is 3.5 million. So this is why debt is not a dirty word when it comes to real estate, as long as we're using it in a smart way. Now, the last strategy I want to touch on is called the value add strategy. So value add. And it's a mix between that the BRRRR strategy and the long-term hold. It's a mix. So this is what the value add looks like. So we're going to acquire an apartment building. Let's say we acquire the apartment building for 10 million bucks. And so maybe we're going to raise, let's say, 4 million. So investors will bring 4 million. We're going to get $6 million worth of debt. And we're going to do some work to this asset. Now, there's 2 levers we're looking to pull. We're going to pull the physical renovation, physical improvement lever. So this is where we're doing renovation similar to the BRRRR method. So we're looking at the asset and saying, okay, well, do the kitchens need renovations? Can we do the floor, the exterior, the signage, all of that type of stuff? What can we do to improve the asset? We're going to do those renovations that we know that are going to earn us a return. Now, on the other side, we're looking at operations, ops. How can we improve the efficiency in terms of how we run and manage the asset? What systems do we have to put in place? Do we change the marketing? Do we change the rent? Do we change the staff at the building? All of these things go into that. So we're pulling these 2 levers to increase the value of the asset. Now, what do we do at this point? We have a couple of options. Number 1, so generally with the value add strategy, you're going to be holding the asset for 5 to 10 years. So it's not like a quick flip where we're just trying to flip it. We want time in the market as well. And this is why I say it's a mix between that BRRRR strategy and then also that long-term hold. So we're looking to stay in the market for about 5 to 10 years. So what happens is in the first 2 years, generally, year 1 and year 2, we're going to do all the renos and all the changes that we want to put in place with this asset. Now, what's happened at this point is we've increased the rents. And because we're talking with apartment buildings, how apartment buildings are valued, we've actually increased the value of the asset. It's more valuable. It's paying off more dollars. So now we actually have the opportunity to go to a bank, the lender, and say, hey, just like with the BRRRR, hey, we've acquired this asset. We bought it for 10 million. We've improved it. We've done renovations. We're generating more rents now with it. The asset's worth a lot more. We actually want to put more debt on the property. Great. This is called a refinance, a refi. Now, what that allows us to do is we're able to take money out now, and we're actually able, in this case, we're raising money from our investors. We're actually able to return money back to the investor. Now, we want to definitely take advantage of the long-term strength in the marketplace. We just don't want to get into house flipping because that's not investing. Like, that's the business of house flipping. We want time in the market because we've acquired an asset in a great location. We think there's a lot of runway there. We see a lot of growth happening. We know that market's going to give us an extra push on top of the renovations and all the work that we're doing. So what are we going to do now? We're actually going to hold it for probably year 3 to year 5. So we've done all this work to the asset. We've changed the management. We've done these operational efficiencies, and now we're going to hold it for another, for year 3, year 4, year 5, and now we're going to look to exit once we hit this point. So we're getting the strength of the market pushing behind us, as well as the work that we're doing here. Now, when we exit, we have a couple options. Number one, well, we can just like refinance again and then pay out all the investors, and then we're basically holding this property with none of our own money in it. Or number two, we're exiting, we're selling the asset, we're getting a big fat check, and now we're able to roll into another type of asset or another property with our investors. Now, you might be thinking, hey, Seth, well, why would you want to do that? Why would you want to actually roll this money into another asset rather than hold it long term? It all comes back to your business plan. And let me explain. If we're always looking to optimize the asset and earn the highest return we possibly can. Now, if we come in to this apartment building and we renovate 80% of the units, let's call it for this example, or 70% of the units, right? And we've done that in the first 2 years. We've done a lot of work up front. We only have 20% of possible lift left to us. Now, does it make sense to hold the asset for another 5 or 10 years to get a 20% additional lift? Is the juice worth the squeeze at that point? Or since we've achieved the 80% of the total maximum improvement in the asset, we've done most of the work, doesn't it make more sense to actually exit, take those proceeds and roll into another deal and rinse and repeat? And this is why when you're looking at a portfolio, if you're a passive real estate investor, if you're working day to day in your career, if you're a high income earner, but you want to take advantage of the tax benefits, the appreciation, the stability, the cash flow that real estate provides, finding a syndicator or a fund manager that does real estate deals like this, like buying big apartment buildings, and then you're investing with those with that group. They're implementing their business plan, they're doing the renovations, and they can send you those checks every single month. And then the big checks when there's a refi or a capital event like a sale. This is what works really well for us because we're able to acquire an asset, quality asset. We're able to pull those two value levers, physical improvements or operational efficiencies, oftentimes both. We do the work, we do the improvements in the asset. Sometimes there's a refinance, sometimes there's not. We never promise one. And then we sell. Now we're able to take those proceeds to get your check and you roll right back into it in the next deal. And then we can do that. And you're not sitting there with idle or dead equity. So I hope this was helpful. So if you're looking to get that portfolio going, check out the BRRRR, check out the long-term hold, 100% check out the long-term hold, and then value add as well. All right. So I'll see you next Monday on the Real Estate Show. See you then.